It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. I want to discuss today probably the biggest thing on people's minds in terms economically at least, and that is inflation. The latest numbers, of course, are 7.9% inflation year over year, so a year ago. And those are the highest numbers since 1982, which is the tail end of the 1970s high interest rate environment we had then. So this is definitely generational type of inflation. Again, this type of inflation we haven't seen for 40 years. And we're going to discuss today what to do on a lot of things about this. But what I want you to understand is when you're dealing with a high interest rate, or I should say a high inflationary environment, obviously, as we know, the prices of things, goods and services increase. The cost of energy, food, things like that have gone up. And it just costs more to live is what it really boils down to. The causes of it, I'm not discussing at the moment. We may get into that a little later. But the reality is we're dealing with the fact of higher costs on pretty much all the staples, all the things that we need. Is it going to be transitory? Well, that's pretty much been off the table for a while now. First, we were told that by the Federal Reserve and other people. Of course, they were wrong. There's discussions and arguments. Even Janet Yellen, former Treasury Secretary, former Fed Chair, current Treasury Secretary, I should say, has said, we're looking at uncomfortable inflation rates for at least a year, if not longer. She came out and stated that recently. We still have people out there saying it's going to be over in the end of the year because they're blaming it on various things like supply chain issues and all that. Here's the thing about inflation. It's far easier to prevent than cure. Once that genie gets out of the bottle, it's really, really hard to put it back in, if you know what I'm saying. There's a lot of causes behind it. But again, I don't want to discuss that so much today as what to do and how to address it moving forward and what the impacts are. Because it's been so long since we've dealt with a high inflationary environment. Again, it's been 40 years. It's been a generation. And unless you're somebody who's a little bit older, you don't remember. And so for a lot of people, this is the first time they've ever dealt with or seen real inflation. Now, the other thing I want you to understand about it is the way that the government, the CPI, the Consumer Price Index, is what they're talking about. The way they count inflation today is different than the way they counted it back in the 1970s and early 80s. In other words, the CPI figures today don't include food and energy. Now, what does that mean? Well, those are the two things that increased the highest in costs recently in this past year, certainly. So a lot of the experts talk about this, that if the government was to count the CPI, the Consumer Price Index today, the inflation rate, in other words, today, the same as they did back in the 1970s, we would be easily looking at double-digit inflation, which means this is the highest inflation anybody alive has experienced. So this is the most intense, the worst inflation anybody alive has ever seen in the United States. Other countries have experienced high rates of inflation for various reasons at various times. And the problem is, for the most part, none of those situations or scenarios are very pretty. So I want you to understand there's definitely some steps you can take to protect yourself. But, this as well as it's real. It's here. We have to face it. We have to deal with it. So first of all, what do? Well, generally speaking, high inflation is not good for the markets, the stock markets, for example. Now, not all stocks, but, the price of a stock, for the most part, not always, but is generally based on, the profits of a company and the ability for a company to make a profit. When the cost of goods and services, when it costs more to make stuff or transport stuff or whatever, that's generally bad for business, okay? And so that's why, generally speaking, it's bad for stocks. And that's why you've seen some of the high-flying companies, the tech stocks, and a lot of the higher flyers in the last few months really take a beating recently because of the inflation concerns. So there are places you can look into, but if you do, you definitely need to change your game up, so to speak, and change what you're invested in. And certainly I would recommend talking to somebody who has some expertise in that and really reconsider or reallocate funds and things like that. Another area to look into, of course, is commodities, assets, hard, tangible assets, right? So a lot of people look to like precious metals and various things like gold and silver and various things like that. Real estate's another one. The problem with real estate, by the way, although it's a tangible asset, it's typically hurt by inflation also because the higher interest rates that typically come with inflation. See, the number one tool the Federal Reserve has to fight inflation is, of course, to increase interest rates. Well, increasing interest rates increases borrowing rates and increases monthly payments on mortgages, which pushes the prices of real estate down, tends to push it down. So a lot of people out there are really predicting an adjustment in the value of real estate. We're going to see what happens. So that may or may not be a good solution. Okay, as I mentioned earlier, precious metals, gold and silver, for example, things like that, have been touted over typically as a good hedge, and it may be, but there's some real question marks about gold in particular. And, gold has always been sort of the safe haven historically where people would go to when the economy was not doing so good or inflation or whatever, right? Well, the most recent example I can point to is, the COVID shutdowns, March of 2000. We had, historical stock market drop of about 30% in 30 days. And that was because, of course, the shutdown, basically shutdown of the economy. And if you go back and look at that, you would think normally, economy shutting down, the stock market's dropped 30% overall. That's when gold would soar, right? I mean, normally you would think that. The thing is, if you go back and look at the charts and all, gold didn't do anything. And at first, it was confusing. Looking into it further and understanding it better later after the fact, is that about 80% of the gold reserves in the world are held by the central banks of the world. And so basically the central banks, I'm talking about the Federal Reserve, the Bank of Europe, the Bank of China, etc. The thing is, if you control 80% of the supply and they coordinate or decide to work together, which apparently they did in that situation, if they don't want the price to go down, basically it's not gonna, because they can, flood the market, so to speak, right? And in essence, that's what's happened. So the central banks of the world can really, they didn't want to see gold jump up, so they made sure it didn't. So I'm not so sure gold is the best solution anymore to a crisis, because again, do you want to bet against the central banks? And oftentimes the political situation, for example, of a country or multiple countries, and the central bank are in line, if you know what I'm saying. So if they're in line, I don't know, if you trust that, they can control, they can manipulate the price, unfortunately. So that's a question mark, okay? So I'm not saying somebody shouldn't do any of these things. I'm just giving you some food for thought here. Another one that's come up, obviously more recent, and by the way, I guess got to say I'm still got that COVID cough. It's getting a lot better, but I'm still recording from home, so I don't have the sound engineer to knock out my cough. So I'm trying to power through like I've done the last couple weeks. And if I do have to cough, I apologize. But cryptocurrencies, Bitcoin, so things like that have been touted as an inflation hedge. Now, I don't really have an opinion one way or another on those, because the main reason is simple. They're too new to really know what they're going to do in a real crisis. In other words, they were created and invented basically fairly recently. And for the last decade plus, we've had a very strong economy, low interest rates, very dovish Fed, basically encouraging the stock market to go up and being very, it's been a very smooth and very upward trending market. There hasn't been a crisis since 0809, and the reality is in 0809, cryptocurrency was in its infancy. I mean, almost nobody knew about it back then. So it was barely existed, is what I'm trying to say. How's it going to handle a crisis like we're dealing with the high inflation? That remains to be seen. It's untested, is what I'm trying to say. It certainly has the potential. So those that are bullish on cryptos, it has the potential to be offset, but will it? And so far, I can say in the first few months of the last few months of last year, the first few months of this year, where our economy has really started, it's really adjusted, taken a nosedive. The markets have really changed, taken hits. Cryptos have not performed. It seems like when the market goes down, so does crypto. And they seem to be pretty well, and I'm talking about the high flyers. In other words, it seems like a lot of the people, and this is just a theory of mine, okay? I'm just going to say, looking at this and, watching the markets for the last 20 plus years and being involved with all this stuff, what it seems to me to be is a lot of the same people that invest in like the high flying tech stocks, the Teslas and the, those kinds of stocks, Nvidias and those kind of companies, are also the same people that invest in cryptocurrency. And so when those high flying tech stocks drop, so does the crypto and vice versa. They seem to kind of work together so far. I think, like I said, it's only been a few months. It's untested. We'll see how it works out. But I wouldn't am I saying not to invest in any crypto? No. But would I put a significant amount in there? No, I wouldn't do that either, because again, it's untested. The place that I see for high interest rates that is tested and has some security to it is interest rate sensitive assets or dividend assets. Banks and CDs and things like that have been out of favor for a long time, for the last decade, but it's because interest rates have been so low. Your personal bank is a dividend. It's one of the highest dividend-paying options out there, 5.75%, 6% tax-free with guarantees, and you get positive arbitrage. So all those are pluses. But it's at the low end of, historically speaking, of what it pays. So stay tuned to the next segment. I'm going to talk about what happens when interest rates start to climb and what happens to all this. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're discussing inflation and the effects of it and really what we can do to navigate it. If in the first segment I was talking about the various investment options and how they're affected by inflation. So if you did miss it, I'm going to go and encourage you to go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows anytime you want. But I did go through the different options that are out there, from the stock market, real estate, cryptocurrencies, precious metals, interest rate sensitive assets, all of that. And I think if you want to learn more about that, really good to go back and listen to the first segment of the Your Personal Bank Show at yourpersonalbank.com. So, what to do, right? What to do and what to look at. So here's some other thoughts that I think are valid, because again, we're definitely dealing with generational inflation. The most current rates for February of 2022 were 7.9% consumer price index increase. That's inflation. Those are the highest. That's the highest increase we've seen since 1982. That's 40 years, basically. Well, it's 40 years, yeah. And so that's generational. And again, the government doesn't count CPI or inflation the same as it did back in the 1970s. So if you listen, most economists, experts will say, look, we're in double. If you count fuel and food, which they don't count, they remove that out of the CPI, which is two of the biggest expenses for the typical American. It's a joke. But anyway, it'd be easily double digits. So we're really in the highest inflationary environment anyone's ever seen in their lifetime that's alive. Okay? This is historical. So is it, and we talked about how long is it going to last? Well, the reality is inflation tends to last a lot longer than people think it's going to, because the fact is it's just really, really difficult to stop once it gets started. And, we still have a lot of factors that are contributing to inflation, and if anything, could cause it to continue to go higher rather than lower from this point forward. We're going to see what happens, but inflation is real. And it's significant. And it's going to impact people's lives financially. It already is. But it will impact them significantly more and longer, I think, than unfortunately a lot of people are willing to admit even right now. So, what do we do? How do we cope? How do we handle? Like I said, as I went through the list of different assets out there, really one of the best is interest rate sensitive or dividend sensitive assets. And there you can get like dividend paying stocks and dividend paying bonds and stuff, but one of the highest payers out there happen to be your personal bank policies. And as I've shared this, and I know it may sound a little self-serving, but it's true. I'm sharing the truth. The facts are that these insurance companies have been paying dividends of 5.75 plus rates for the last 25 plus years. And have never missed paying a dividend since some of them since before the Civil War. Okay? I mean, that means they've paid dividends through the Civil War, both world wars, the Great Depression, and everything in between without missing a single year. Folks, that's impressive. They've got tons of cash reserves. They're well positioned to continue to pay those. One of the CFOs of one of the companies, this was a couple of years ago at least, stated, if we added no new clients, we could pay our current customer base the current dividend rate for the next 100 years. I mean, that's the kind of cash reserves and these companies are sitting on, positions they're in. And so one of the big questions I get about your personal money is like, okay, 5.75, that's pretty decent, or 6%, whatever, tax-free, okay, with guarantees, and then you can access it from the bank lines, and the banks are charging 3 to 3.95. So when you do access the funds, notice when you spend the money, you get to keep the difference. The average is 2 to 3% positive arbitrage, okay, which is keeping the difference. So you're still earning 2 or 3% on money you spent. So you're earning 5.75, 6% while it's just sitting there growing. That's easy to follow and understand. But when you do need money, and guess what? That's the reality of life, isn't it? We all spend money, whether it's on food, clothing, and housing, or anything else. We need money to spend. Think about if you could pick up 2 or 3% interest each and every year for the rest of your life on that money you spent just on even basic necessities. Would you have more money in your pocket? The answer is, of course you would. And when you're in an inflationary situation like we are now, getting your money to go farther is more important than ever, isn't it? And in last week's show, I even shared so many opportunities are presenting themselves today for a lot of people because they're doing things, they're transitioning a lot of their assets because, well, if they were invested in the market, let's say, they're repositioning their portfolios, right? So a lot of times if somebody's invested in something that's doing well, they're reluctant to change because it's doing well, and it might create a taxable event or something like that, whether it's a piece of real estate or a stock investment or whatever, right? But when you're making those changes anyway, because the economy's changing, inflation's changing, you've already factored that in. So now you have opportunities to allocate those funds. You can reallocate those funds, of course, reinvest them into other options. Or why not take the money, put it into a dividend-paying policy, earn 5.75, 6% dividends on it, then turn around. You can do that within the first week or two. Turn around and take the funds and access them from the bank line, pick up 2 or 3% positive arbitrage, you're keeping the difference, and reallocate the funds, reinvest. What happened? Well, you just added 2 or 3% return on your investments, whatever that may be. Look, if you get a 10% return on your money, you're now getting 12, 13. Do you think that's significant? Folks, that's huge. That's 20, 30% more return on your money by using this tool. So if you are in a position when you're transitioning funds, I'd strongly recommend you contact me at toll-free 866-268-4422 or yourpersonalbank.com. Share with you how this can work. But one of the other big questions I get when I'm sharing this concept of getting the dividends, reducing the taxes, getting the positive arbitrage, having access to your funds is, okay, I understand I'm keeping the difference. I'm getting that 2 to 3% positive arbitrage when I spend the funds. I'm getting the difference of what I'm earning in dividends versus what I'm getting charged by the bank, and I'm keeping the difference. And the gap is about 2 to 3%, depending on the size of the account currently. Well, if interest rates climb, which is very likely now with inflation, what happens? Because the bank lines are going to certainly increase their interest rates when interest rates climb, and that, of course, is true. Well, I'm going to encourage you to stay tuned in the next segment because I'm going to answer and cover that very issue and share with you how historically, and I'm talking over the last 40 plus years, historically documented facts that this positive arbitrage situation has been true pretty much every month for the last 40 years. Okay? So, in other words, you're going to find out by staying tuned in the next segment. I'm going to share with you how that this positive arbitrage situation works in a low, medium, and high interest rate environment. It just doesn't matter, okay? So again, I'm encouraging you to stay tuned in the next segment, and you're going to learn exactly how and why that is the case, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. So, as I was discussing at the end of the last segment, one of the big questions I get is, okay, I understand. I take funds and I put them into a dividend-paying policy to earn dividends. And the current rates are around 5.75%, 6%, depending on the company. Long history of paying those dividends that are higher. Never missed since before the Civil War. That's all great. Then when I want to access money, I access it for whatever reason. I access it through the bank lines. They're charging 3 to 3.95 depending on the size of the account. So the positive arbitrage is basically around 2 to 3%, keeping the difference. Because again, I always say, if you're earning dividends of 5.75, 6%, and you get charged 3 to 3.95, what's your money doing for it? Doing for you, and it's still growing. You're keeping the difference. That's the positive arbitrage, right? And remember, folks, if you leave the money in the policy to earn dividends, it's going to earn. It's going to grow like any investment does. What the positive arbitrage comes into play when you spend the money. And as I always say, that's the key point to understand. Where else can you earn interest on money you spent? And look, if you can show me how to do that, I'm interested. I'm all ears. You know what I mean? This is a powerful, powerful tool, and especially now with inflation, your money needs to go farther, doesn't it? Because it's not going as far as it was even a year ago, right? So this is imperative. It's gotten more and more important than ever. But the question I get all the time is, okay, I get all that, but what about, the banks are going to change their interest rates? Well, if Fed starts increasing rates, which we fully expect them to do, the borrowing rates, the lines of credit are going to change. And absolutely, that is the case. Here's the key to understanding why this works historically long term. And I'm talking about, I've got a spreadsheet showing where there's been positive arbitrage every single month for the last 40 years, except for 2 months, and those 2 months they happen to be equal, so you weren't hurt. So historically this has worked. In other words, that 2 to 3% positive arbitrage has been a historical average, whether we're talking about a low, medium, or high interest rate environment. And why is that? Well, it's because both are highly correlated. The dividends that you're earning are interest rate sensitive. The bank lines of credit you're borrowing, the interest you're getting charged is interest rate sensitive. They correlate. So when interest rates go up, both tend to go up. When interest rates go down, both tend to go down, right? And they're highly, highly correlated. So let me give you an example. As I've stated numerous times, the current dividend rates are 5, 7, 5, 6%, depending on which company we go with. And there's various reasons why we choose which ones and such. And I'm independent. We work with anybody. Doesn't matter. So we're going to get you the best rates that are available, get you the most cash, period. And I'll share with you why. You'll understand. Look, if you contact me at toll-free 866-268-4422 or yourpersonalbank.com, I'll be happy to share that with you. Why we choose who we choose and why you get the most money. That's simple to share. But the thing is, the point I want to get at is that's the 5, 7, 5, 6% dividends that they're paying currently is the low end of the historical time frame. In other words, we are in the lowest interest rate environment in the history of our country since 1787. That puts things in perspective a little bit. This is beyond historical low interest rate environment. So even as low as look at bank. Everybody understands this. Look, go to a bank. What kind of interest are you getting on a savings account or a CD? You're lucky if you see 1%, right? Really ridiculously low rates, right? Well, the dividend rates are highly interest rate sensitive, and we're at the low end of the spectrum, the lowest we've seen in the history of our country. Folks, you understand, buy low, sell high, right? In other words, what were dividends in a normal interest rate environment? And I've got the charts to show you what they were. If we go to late 90s, early 2000s, when we were in a normal interest rate environment, the dividends were 7-8% with pretty much every company. In other words, 7-8% dividends is the norm. And when we were in a high interest rate environment back in the 70s, dividends were double digits. It's all relative. It's interest rate sensitive. So as interest rates climb, the banks will charge interest, the line of credit rates will increase, but so do the dividends, and they're highly correlated. So the 2 to 3% positive arbitrage scenario tends to hold true and has, like I said, every single month for the last 40 years, except for 2 of those months where it happened to be equal and you weren't hurt. And by the way, worst case scenario, you can always use the funds in the policy to pay back the bank loan anytime you want, because remember, the cash in the policy is the collateral for the loan. So you always have the option of just paying the bank off. So if interest rates got totally out of whack for a while, maybe one moved faster than the other, you always have the option of just paying it off and being done, and you're not being hurt. In other words, you're always in control. I like that option. I like knowing I'm always in control. If things get like crazy out of whack, I still have control of my money. I'm not stuck. You're not locked in. Now, there's one last thing I want to share with you in terms of the borrowing rates with the bank lines, and share with you why this would be the cheapest place you can borrow money from, period, going forward. So I'm going to strongly encourage you to stay tuned, and I'm going to share that with you in the next segment.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. So we've been discussing today inflation, how various assets are affected by that, how the Your Personal Bank concept is a really, really strong contender because it's in a higher interest rate environment, because it's highly interest rate sensitive in terms of the dividends you earn. So how much you make is highly interest rate sensitive. So if interest rates do go up due to inflation increasing and stuff, the Fed starts increasing rates, which everyone fully expects, including the Fed, of doing, it means that the dividends of 5, 7, 5, 6% that we're getting paid today, now the lowest interest rate environment in the history of our country, are most likely going up. Because the historical, if you go back to like late 90s, early 2000s, I can show you the charts, 7-8% was the norm for pretty much every company. So 7-8% is actually the normal dividend rates that are paid in a normal interest rate environment. We're in anything but a normal interest rate environment right now. We've had the lowest interest rate environment for the last decade plus in the history of our country. And, investing has, it's funny, there is a basic rule we all know, and that is buy low, sell high. Interest rates at the lowest rate they've ever been for 200 years. And the Fed has made it clear they're going to go up. Your personal bank, the dividends, the dividends and the policies is based on interest rates, highly correlated to interest rates. Remember, buy low, sell high. You have a generational opportunity to get into something at its low, where it's paying the lowest rates it's ever paid, and is only going to go up most likely, particularly in the near to medium future, the next several years at least, because of inflation and the interest rate increase that's going to go with it. But on top of that, you can create the positive arbitrage, because remember, you're just putting the money in the policy to earn dividends, but then when you want or need money, and we all spend money, right? You can access it through the bank line at a lower rate than you're earning dividends. And the difference is usually 2 to 3% range. The bank lines are charging 3 to 3.95% currently. Now, is all that going to change? Most likely, yes. In other words, when the Fed raises interest rates, we're going to see an increase in the bank line rates, what they charge, interest they charge. We're also going to see increases in dividend rates that the insurance companies pay. And again, over the last 40 years, historically, the average positive, the difference, the gap, what you keep, the positive arbitrage is 2 to 3%. But it even goes beyond that. In fact, in the short term, this actually, in the next couple of years, could end up being a much, much better tool than that even. And here's what I mean. The actual borrowing rate from the bank lines is not 3 to 3.95%, depending on the size of the account. It's actually it's based on what's called the Wall Street Journal prime rate, or what's known as prime. The prime rate minus 0.5% to minus 1.25%, depending on the size of the account. There's basically 3 tiers. In other words, depending on how much you have funds you're working with, the borrowing rate, the rates that the bank lines are going to charge you when you access the funds, because these are fully collateralized loans, it's going to be the cheapest money you'll be able to access, period, anywhere. And here's what I mean. The Wall Street Journal prime rate, or the prime rate, is generally considered the lowest rate a individual borrower can borrow money with really, like perfect A plus credit, right? So you have the ideal borrower, the ideal rate, and that's about typically the lowest rate an individual borrower is going to be able to access money or borrow money, okay? The prime rate currently, right now, as it sits, is 2.75%. And if you think about that, that's interesting, because I have clients who have done mortgage refinances or mortgages recently in the last couple of years or so that have rates in the high 2s on their mortgages. And their credit's perfect. I mean, they got perfect credit, right? They're A-plus borrowers. Again, that's about as low a rate, about as low as you can borrow money, right? In the high 2s. 2.75 is the current prime rate. Okay? And then everything else is usually prime plus, whatever, right? Depending on what it is, if it's an auto loan or other types of loans, or what your credit is like, or whatever, right? Well, these borrowing rates from these lines are prime minus. And again, it's minus 0.5, minus 1, or minus 1.25, depending on the amount of funds. So here's the deal. Think about that a minute. The rates, I said earlier, and I'm not trying to get too much into the weeds here, but this will really follow me for a minute, and this will make a lot of sense. I've been stating that the borrowing rates are 3 to 3.95, but yet the actual rates are prime minus 0.5 point to 1 minus 1.25, right? Which would mean, let's say you were prime minus 1. That's one of the most common. That's the middle tier, right? Well, if you were prime minus 1 right now, prime is 2.75. That means your borrowing rate would be 1.75, right? Well, the reason why the banks don't do that is they can't operate on that thin a margin. They can't make any money. So they all have a floor. All the bank floors are between 3 and 3.95%, because each of the individual banks have determined that's the lowest rate they can loan money at and still make some kind of profit. So I'm going to take the most common situation with most common client. This is the middle ground, middle tier, okay? If you have more, you'll get better rates than this. But bottom line is, the most common rate that my clients are getting are 5.75 dividends. That's the highest dividend payer, highest cash. And they're getting charged 3.25 from the bank when they access the funds. That's, again, the middle tier. That means they're getting a 2.5% positive arbitrage, which is also happens to be right in the middle of the average, historical average, positive arbitrage, right, when they access the funds for whatever reason. Well, 3.25 is the floor, but the borrowing rate for the middle tier is prime minus 1. So follow me on this. Prime is 2.75, but they're actually borrowing at 3. So in other words, prime minus 1% means the prime rate would have to climb to 4.25 before their loan rate would still be the same. Okay, prime is 2.75 right now. It would have to climb to 4.25. That is a 1.5% increase. Or in other words, that would be 6 quarter-point interest rate hikes with the Federal Reserve, for example. Typically, the Federal Reserve, if they're increasing rates, will do it quarterly, and typically will do it on a quarter-point basis. Okay, that's the most common scenario. So that means if they did it 6 times every quarter for the next 6 quarters, that's a year and a half from now, they increase the interest rates every single quarter. Your borrowing rate from the bank line wouldn't change. It'd still be 3.25 because you'd be prime minus 1. Okay? Because the prime at that point would be 4.25. You minus 1, you're 3.25. Here's the other part of it to understand. So we can see a 1.5% increase on the prime rate, the Federal Reserve, and see no difference on these bank line rates. So realistically, I mean, we're talking next year or two, right? Before we get to where, we're at the rates, at the floors. But if the Fed does increase interest rates six times, 6 quarter-point interest rate hikes, let's say, over the next year and a half, what do you think the dividends are going to do? They're highly interest rate sensitive also. In other words, they're going to start climbing. So we could see a scenario over the next couple of years in particular where you start to get higher dividends and your borrowing rate doesn't change. In other words, the average client who's getting 2.5% positive arbitrage today could see 3% or 3.5%. You see what I'm saying? Now, they'll settle out and balance out eventually. You know what I mean? But we could very likely see a scenario where that happens, where the dividend rates start to climb because interest rates are going up. And the bank line interest they're charging doesn't because we haven't got to the floor yet. You see what I mean? They're either going to be at the floor rate or the prime minus 0.5% to minus 1% or minus 1.25. So and again, when you look at the historicals over the last 40 years, this positive arbitrage scenario has been in place for the last 40 plus years, every single month. You can start to see where, gosh, this works out really well in low interest rate environments, average and high interest rate environments. And because we've been so low, we have somewhat of a unique opportunity of seeing even bigger positive arbitrage gaps. Now, why is that so important? Folks, as I started the show with, the biggest economic concern most people have today is inflation. Inflation eats away at the buying power of your money. Your money has to go farther to just keep up. You know what I mean? In other words, you have to maximize the growth on your money even after you've spent it, getting the positive arbitrage, remember, earning the dividends, access to the bank line, keeping the difference, to maintain your buying power. Otherwise, you're losing ground. And right now, currently, the rates we're looking at, you're losing ground at about 8. If the money's not invested, if you're just sticking in the bank or a mattress or whatever, you're losing about 8% a year right now on your money. In other words, $1,000. Well, let's make it easier. You got $100,000 a year ago, and you did nothing with it. It basically sat in the bank, earned nothing. It's now worth $92,000. You lost $8,000 in 1 year. See where the positive arbitrage on the spent dollars starts to really come into play to help you keep up and maintain with inflation. And remember that positive arbitrage. If you take some money, you put it in the policy and access it through the bank line and spend it, that positive arbitrage of 2 or 3% isn't one time. It's every single year for the rest of your life. Compound. You start understanding the value and power of compound interest, you will actually end up with more money than you think you will or realize, because your money is going to keep growing again, even after you spend it, because of the positive arbitrage you will be earning on that money. The difference between the dividends you're earning and the interest rate the interest of the bank's charging. You're keeping the difference. As long as there's a gap, you're ahead of the ball game, right? And you're making money on that money that you spent or reinvested in other assets. So I'm hopeful that some people, it clicked for them. I know there's a lot of folks who have been listening to me for, in many cases, months, if not even years, on the radio show. And most of the time when somebody contacts me, they're very much intrigued. They have a genuine interest. And they like the idea of the positive arbitrage. I mean, who wouldn't, really, right? It just means you got more money in your pocket. The safety, the guarantees, the tax-free, all that's kind of nice, too. Don't get me wrong. But it's that positive arbitrage. It's that power of being able to earn interest on money you spent every year the rest of your life that genuinely can make the difference financially of you just getting by like most average Americans do. The middle class, there's no question, are under attack, particularly due to inflation, more than probably anything else. There's no question, financially, the middle class is under attack. You're either going to move backwards or you're going to move forward. I think Mark Twain said that. And with inflation and running at about 8%, according to the CPI, that's not counting food and fuel, okay? So it's double digits. So you're really losing probably 10 or 12, 15, I've seen 14% estimates, but you're losing double-digit ground each year as long as this lasts, or you're going to find ways to move forward. There's no standing still anymore, particularly with inflation. If you want more information or have any questions, contact me at toll-free 866-268-4422 or yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.